Yo, what's good? My name's Kang, and in this video, I'm going to be going over how I personally invest as a software engineer, as well as a big mistake or inefficiency that I think a lot of software engineers might run into. And make sure to stick around to the end because I'm going to be talking about how I've actually made one of these big mistakes as well. But to understand my investment strategy, I think you first have to understand how compensation packages work in the world of software engineering and in the world of tech. So for a lot of people in software engineering or people who work in tech, their compensation packages can be split up into three major parts, which is salary, some sort of equity, and some cash bonus. Now the salary and the cash bonus part is pretty easy to understand. Everyone's pretty familiar with cash, but the equity is where things can get a little bit dicey because there's so many different types of equity and it can be a bit confusing at times. Now I think the most common form of ownership or equity that you're going to get is in the form of an RSU. RSU, or restricted stock units, is a type of compensation that is in the form of a company stock that is distributed over a certain vesting schedule, and this vesting schedule will differ from company to company. So one of the most notoriously well-known vesting schedules in the tech industry is, I think, Amazon's stock vesting schedule. So in the first year they give you 5% of their stock, in the second year they give you 15%, and in your third and fourth year they're going to do 40% in each year, split into 6-month chunks. And that's one way to do a vesting schedule, but I think for the majority of companies it's usually split evenly over the span of like 4 or 5 years. So it's important to note that your RSU grant is a promise of a number of shares and not necessarily a monetary value. So that means if the price of your stock increases while your RSUs are unvested, your RSUs have risen in value, and the vice versa is true if the stock price declines. So for example, when I got hired, I had an initial grant of 400 shares that was spread out evenly in 4 years, which means every year I would get 100 shares of my initial 400 shares grant. At the time when I joined, those shares were worth roughly $120,000, but since the stock price has increased in value, my RSUs are now worth around $160. Another thing to note is that RSUs are not only awarded during your initial hire phase, but they can also be awarded to you while you're working. So many employers will actually give you more RSUs as an incentive to stay. These are usually called refreshers, and these refreshers usually come around when you're getting your bonuses for the year or when you're getting a promotion. So RSUs are taxed as ordinary income. Now, I can't speak for every single RSU policy across every single company, but from what I understand, the majority of companies will withhold some of your RSU in order to pay for the tax that's required for it. Now, the exact percentage that's withheld is again going to depend on what company you work at and what policy they have. But I think what ends up happening is that you will receive less than the amount of shares that you're expecting. So instead of receiving like 100 shares, you might receive 65 or 70 shares. And those shares that are withheld are used to pay for the taxes that are owed on the RSU being given to you. So since some of these stock units are withheld in order to pay for taxes, by the time that it hits your brokerage account, these shares are fully yours, taxes are paid for, and it's your decision on whether to sell them or to hold on to them. Now, if you're selling your RSUs immediately, there should be little to no capital gains implication. However, if you choose to hold on to your RSUs for a longer period of time, then you're going to have to pay capital gains tax depending on how long you've held your RSUs for. So if you sold it within a year, you're going to have to pay short-term capital gains tax, which is taxed at your highest marginal bracket. Or if you held it for longer than a year, you'd be paying long-term capital gains tax, which will depend on your tax bracket, etc. Now, this is in the scenario where the value of the stock is increased, but in the situation where the value of the stock is decreased, you'll be doing a capital loss, which you can use when you're filing for your taxes. Now, RSUs are great, but I think it brings up a very crucial risk, which is actually owning too much of your own company stock and keeping all of your RSUs. Let's first, I can imagine you work at Apple and you've got some RSUs on them and you're very bullish on the success of Apple stock and Apple as a company, so you've kept all of your RSUs. Now, by choosing to keep those RSUs and not selling and diversifying, you are making the active decision to put all of your eggs into one basket, or a lot of your eggs into one basket, and that basket is being Apple and Apple stock. Now, let's say Apple does a really bold move and decides to put the headphone jack back onto the iPhone. Everyone loses their mind, they really don't like this idea, and the stock price plummets, and now your job is in jeopardy of a potential layoff. And also, side note, I just made that up right now, I would much rather have the iPhone with a headphone jack. But moving on. Now you can see that you're kind of getting double screwed here. Number one, you're getting your salary from Apple, and then now you have a potential risk for layoff and Apple's not doing well. And then number two, since you were so bullish on Apple, you're holding so much of Apple stock and has tanked in value. Now, instead of being double screwed here, you can mitigate some of your risk by selling some of your Apple RSUs when it's first vested into your account and diversifying into other assets. Once those RSUs hit your brokerage account, they're as good as cash if you immediately sell them. Now, if you choose to hold on to your RSU, it's like your employer that's giving you like a $20,000 bonus, and then you turn around and immediately buy $20,000 worth of your company stock. So when thinking about RSUs, another way to look at it is like, if I had been given the cash value amount that I got in the RSU, say like 10K, 20K, 30K, would I have bought my company stock? Now, another point that I want you to consider is that you still have an enormous amount of upside when it comes to your company stock in the form of unvested shares. So let's say, for example, year 2 out of a 4-year initial grant vest from when you got signed on, you still have 2 years of potential upside or downside through the RSU that has been that's still invested. And this is not accounting for refreshers, which you can also get as you're working and as you get promotions. Now, the last argument that I want to make on this topic topic is that you're already so invested into your company. If you think about it, your job is kind of like an investment. You are investing your time, your energy into the company in return for your monetary salary. And if you look back to the compensation structure for people in tech or people who are software engineers, a large portion of your compensation, especially once you get to the later levels like senior, etc., a large portion of that is actually in company stock. So by keeping all of your RSUs or a large portion of RSUs, you're making a pretty heavy bet on the success of your company. Now, there is a counter argument to be made here, because probably at this point, a lot of you are screaming about NVIDIA in the comments or at your screen or whatever, which is honestly a very fair point. People becoming mega rich off of their RSUs is not something new, and NVIDIA just happens to be the poster child for it at the very moment. But I think it's important to remember that for every winner that you see, there are many losers that you do not. In my opinion, investing, and by extension, I guess the way that you live your life, is all about risk management and risk aversion. Now, to continue, I kind of want to bring in a more holistic view of how I personally view my investments so that you could get an idea of how I'm framing my mind around RSUs and I guess investing in general. When I take a step back and try to think about myself from a third-party perspective, I look at how lucky that I've been, right? Like, I'm young, I work in software engineering, I make a very good amount of money for my age. I've already gotten so lucky once that I don't need to get lucky again chasing Wall Street bets level of insane gains, if that makes sense. My argument is with all the insane amount of success that you've already achieved at a young age, your next goal should not be to chase even higher gains and do some crazy stuff with your investments. Instead, it should just be to not fuck it up. Now, my mindset around this is not only for RSUs, but for investing in, for the most part. I prefer to take an adjusted risk, diversify my assets, and chase very average gains rather than shooting for the next, rocket ship that's going to make me millions. Which kind of segues into my next topic, which is if I'm not going to hold my RSUs, what should I actually sell and diversify into? Well, for starters, I would actually steer clear from adding more tech stocks to your portfolio. A couple things to consider here. Number one, you're already working in tech, so in my opinion, you should try to diversify outside of what you're already in. Now, the second thing to note is that tech right now is a very large percentage of most market cap weights for indices. Now, if you look at the S&P 500, it's like Microsoft, Apple, and like Facebook carry like the top 5 positions or something like that. So even by diversifying outside of tech, you are still holding a very big portion of tech if you hold a major broad indice like the S&P 500. So instead of holding individual tech stocks, what I like to do is try to invest into very broad indices that track a larger market. So say, for example, the S&P 500 or the US total equities market or the total world equity market. Now, if you're a little bit curious about which ETFs you should buy in particular, I would look into r/bogleheads on Reddit. It's a really great resource of people trying to simplify their investments and go away from this style of individual investing. Now, I think trying to chase average returns is what most people should be doing, especially considering people who trade stocks for a living fail to beat the average over a longer period of time. Now, to reel back this conversation a little bit, I don't necessarily think that everyone should be selling all of their RSUs. After all, this is personal finance, and every single person's situation is going to be different from the other person's, so there's no one size fits all when it comes to money, personal finance, investing, etc. I completely understand why people want to keep their RSUs. I personally keep some of my RSUs as well. Now, I think it's okay to make a bet on the success of your company, but I think you have to understand that it does come with inherent risk. So what I invest into is actually pretty boring. I mostly invest into ETFs that track large indices. So for example, an ETF that tracks the US total stock market, which is something like VTI. And to be completely transparent, I also hold some individual stock from my company that was granted through my RSU. Now, I recently did a deep dive on my net worth, breaking down how much money I have, in all my investments, etc., etc. And from that video, I realized that I think I have too much in my RSU because of how much it's risen. It's taking too much of a percentage of my portfolio. So now my plan is to sell all my future refreshers and all my future RSU vest and diversify into other assets while still keeping what I have. Now, the reason that I plan to keep these RSUs is a very personal one for me and may or may not apply to you. It's because I'm actually a Canadian that's living in the US. Now, if and when I decide to move back home to Canada, there is a way for me to cancel out a lot of the capital gains that I have accumulated in my brokerage account. So like I said, what I'm doing with my investments is pretty personal to my life and my situation, and I don't think many people could actually replicate it. And I guess that's why they call it personal finance. Now, one big mistake that I personally made when selling my RSUs and diversifying was the mistake of not selecting the correct tax lot in Fidelity. So whenever you buy a stock or are granted a stock, it comes in a specific tax lot. What that specifically means is that whatever stock that you buy is going to have a specific date tied to it, and that's called like a tax lot. Now, some reasons that they might keep this tax lot information is, just for tracking information, as well as when you're selling your stocks, you need to know if it's been longer or shorter than 1 year in order to pay for short-term or long-term capital gains tax. Now, when you're doing a sell operation, by default, Fidelity picks the tax lot that has been in your account the longest, which is the oldest one, and which probably have the lowest tax obligation for you. So kind of like a first in, first out type of operation. Now, the reason that this was a big issue for me is that with my company, I also get the benefit of an ESPP. Now, if you don't know what an ESPP is, I made a whole entire video explaining how it's so great and how it's free money and you get a free percentage return, whatever. And I'll link it above and below that so that you can go watch it. So what was happening is instead of selling the ESPP that I just got into my account, I was selling my oldest grant, which was actually carrying a tax burden forward, a long-term capital gains tax that I had to pay. So that might have been a little bit confusing. I might not have explained it super well. But the moral of the story is if you're going to be doing selling of your RSUs or whatever stock in general, you should be checking the tax lots that you're selling from just to make sure it's the ones that you want to be selling. Now, if you're curious about the full breakdown of what I invest into and my net worth, you can watch this video right here where I go over that.